Good morning, everyone. Thank you so much for watching my YouTube channel. And today, guys, let's see what is going on with the market. Market today is red. We know, guys. Today they report the unemployment report came today, and it the markets they report they added like 500,000 jobs, and that's why, guys, stock is coming down because we know, guys, when I think rate hike will be still uh, moving up. So let's see what's going on with the stock. Alibaba, Xinjiang province unite toward AI digital economics. So we are talking Alibaba. And then market watch for stock pullback from 10-month high after US latest quarter raised 11%. Uh-huh. So, guys, let's hear what's going on here with the top call Rafian shipping to Amazon EV to AU. Let's hear, guys, what's going on.
I remain concerned about whether inflation will return to target in a sustainable and timely way. And I think more restrictive monetary policy will be needed to achieve the FOMC's goals of stable prices and maximum employment. So my hope was that the overall package of communications coming out of the June meeting would deliver a strong signal to financial markets and meaningfully tighten financial conditions. So at this point, it's important for the FOMC to follow through on the signal that we sent in June. 2/3 of FOMC participants projected at least 2 more rate increases this year. Significant unexpected events could always provide a reason to change course, but inflation and the labor market evolving more or less as expected wouldn't really change that overall outlook. To have confidence that inflation will return to target on an appropriate timetable, we need to see more than some continued, very modest rebalancing. If we lose ground in our efforts to restore price stability, we'll need to do more later to catch up. And the rate increases we need to keep inflation expectations anchored in that scenario would be far worse for workers, households, businesses, and banks than more modest increases now.
497,000 jobs created, according to ADP, during the month of June. That is well in advance of the forecast for 225,000, way ahead of the revised 267 that they say we got in May. Now, ADP for months and months has been coming in lower than the non-farm payrolls number from the Bureau of Labor Statistics. And so if we got a higher number from BLS, you can only imagine what the market would reset to. The numbers are really interesting because most of the hiring was in leisure and hospitality still. And although they seasonally adjust these numbers, I'm not sure if they've got it exactly right, because 232,000 jobs in leisure and hospitality. Now you're going to open all the beaches, the lifeguards get hired, the amusement parks open up. That would increase employment in those areas. But 232,000 is a very, very large number. And you get this 497,000 guys with a loss of 42,000 jobs in manufacturing, according to ADP. So this is quite a number, and it's going to be really, really interesting to think about it tomorrow morning at 8:30.
Well, I think, Mike, you did a great job of framing what's happening with manufacturing and what isn't happening with services. Do you expect to see that in the ISM in about 2 hours' time?
That's been the general pattern, although the ISM for services employment numbers were negative. They were below 50 last month. So do we get that again, or does it start to go up again? I mean, in theory, if you get these kind of numbers at service establishments, especially leisure and hospitality, those numbers should go higher. So we'll see if this is an outlier or not. One other important point, ADP has now started publishing a pay survey. They've been doing that for some months now, and according to the Pay Insights, the overall pay for employees increased 6.4% if you stayed in your job. That's down from 6.6% in May. Job changers slowed for the 12th straight month, 11.2% raise. That's the lowest since October of 2021, they say. So we're getting all this job creation without in theory, significant wage gains, or at least they're slowing. Which, if the Fed were to look at it, they probably would like that. I'm not sure they would. They do use, interestingly enough, the Fed does have its own private index of employment, and they use ADP data to create it. It's not the same. It's not the same index, but they do use.
How successfully are markets right now assessing that expected central bank put?
Hi, Sherry. Great to be back with you. The answer to your question is not very well. This time last year, the end of 2023 dot was at 375. So that was the Fed's dot, and the market was still pushing back on that with a much lower terminal Fed funds rate, and that trend continues. We are starting to see markets getting the memo, at least in the shorter term, but that 1 year out, 18 months out, pricing, if you look at the WIRP function, for instance, on your Bloomberg terminal, nice plug there, you'll see that markets are still pricing in that dovish pivot. The problem is, of course, is that every dovish pivot over the last 20 to 30 years occurred with PCE core inflation below 2%. This time, the Fed does not have that luxury. Core PCE inflation is sitting around 4.6%. So it's very difficult for the Fed to be pivoting anytime soon from our perspective.
And at the same time, we're getting growing corporate profit warnings at the same time. So it's become very, very difficult now to chase that stock rally. So how do you position?
It's worth pointing out that greedflation has been cited by many central banks as a cause of a significant portion of the inflation we've seen since 2021. So there's a fair way to go for corporate profits to come down if you want to appease central bankers, for instance. We are starting to see the thin end of the wedge on that front as the markets continue to toss and turn between inflation concerns and slower growth concerns. So put that together, the risk of continued stagflation. So with all those uncertainties, we are positioned somewhat more defensively in the shorter term. We'll throw in a screen of up in quality and lower vol as well.
How are you feeling about China these days? Of course, it feels like meaningful stimulus measures may not come at this point, right? And at the same time, you're contending with volatility in the currency. Are there opportunities when you take a look at valuations for either Chinese equities or opportunities that have that indirect exposure?
Yeah, so China is seeing record capital outflows at the moment. If you look at from a 12-month rolling basis, that's despite what look to be favorable growth differentials and valuations that appear cheap. What does seem to be holding back foreign investors or tempering their enthusiasm would be the fading optimism around the reopening recovery, the narrowing balance of payment surplus, the narrowing interest rate differential, the rising geopolitical risk premium. I could go on, but we would stress that China's equity universe is just so diverse that bottom-up, much more focused and selective stock-picking approach and credit selection, for that matter, is really key. And so when we think about portfolio resilience in the context of China, we're seeing opportunities around two strategic investment themes. The first is around the energy transition. China's seeing very strong investment growth on that front. And the second is around innovation. So China's seeing really rapid growth in its digital economy, high-value global manufacturing and advanced tech, for instance.
Let's get your take here on what's going on with the Fed and their lack of consensus on where the economy is. They're kind of obsessed with making sure they present a unified picture to the rest of us, even though we know that they are in disagreement over where things stand. What does that tell us about the policy that they enact?
Scarlett, it's deja vu all over again. If we replayed this discussion from 1 year ago, I think it would be the same, which is the Fed's uncertain about the future. They're worried about inflation, so they're going to raise rates. Not sure about the pace. We now know what it was then. And here we are again. Employment is still strong. We're worried about a recession. Katie is talking about an inverted yield curve. Happy birthday to the yield curve. It's 1 year of being inverted. So it's uncertainty all over again. I still think there's a recession coming like everyone else, but we're 1 year into this.
We're 1 year into this, and you point out that CalSTAR's fiscal year ended on June 30th, so you're at the start of a new fiscal year. How were you positioned through the end of last year, and how are you now positioned for this new fiscal year?
You know, it really was a challenge. We started the year last year a little defensive. If you remember, in the summertime, we had a nice rally. Then the market bottomed out in the fall, and then we saw a rally, obviously, in the last 6 months. To answer your question specifically, we've been slightly underweight, so we've a little bit underperformed our underlying benchmark. With that said, we're still almost 45-50% in stocks. Both U.S. and non-U.S. stocks did great last year. It's a bull market. You know, U.S. stocks are up over almost 19% last year. Clearly, as you've talked, it's the largest growth tech stocks that were up the most. But stocks were up. So we did okay, but not smashingly. I expect probably, an upper single digit kind of year. And looking forward, I think the best we can hope for is a single digit year.
Okay, single digit year, not too bad. I know that your fiscal year just started, but if you think about coming into 2023, the big call was that this was going to be the year of fixed income, and so far it looks like it's turning into just another year for big tech. Is it still the year of the bond, or have we moved past that narrative?
Katie, I would say it's the year to pay attention to bonds and to pay attention to the bond market. I think it's still going to be a mixed year. I mean, we're talking about the Fed debating to raise rates, not cutting, debating to raise rates. So, when I think about the Bloomberg Aggregate Index, it's going to have another challenging year. It was negative last year, not by much, but a little bit. The difference is now look at the yield curve last year to this year and how we're talking about yields, close to 5% in the 2-year. Those are attractive income levels. So I think you're going to be able to, like money, buy and hold. In terms of trading in fixed income, it's going to be a tough year.
Going to be a tough year trading those bonds. I want to talk about the credit market specifically, though, because when you say pay attention to bonds, I'm looking at spreads, both junk and investment grade, that have just been grinding tighter and tighter. It feels like every single month. What message do you take from that? And do you think it actually matches up with the fundamentals?
Katie, it's back to the old adage of, sad to say, but sheep get sheared and pigs get slaughtered. I think that people are getting a bit greedy when they're tightening in those spreads. They want yield. People are hunting for yield. That's usually not a good sign. But I have to say, the fundamentals in the stock market are almost equally baffling. We are still seeing earnings. I mean, employment is at a 50-year low. The market, the U.S. economy added 4 million jobs last year. So it's tough to say that investing into corporate won't do okay, but I wouldn't trade it. Again, buy and hold for a period, but don't try and trade it. It's going to be a tough market.
You said the fundamentals in the equity market are baffling. What do the fundamentals in private equity and private credit look like to you now, given that we are maybe going into recession, maybe not? Either way, we're going to kind of bump along this slow growth mode.
Yeah, that recession, Scarlett, I even said was going to happen a year ago. It's still looming out there. Private equity, that market is still almost shut down. We're not seeing many acquisitions. You guys aren't having the classic merger Monday like we used to. We're seeing a few of those. Financing has gone up very high, so it's much more expensive than it was before. And conversely, then, we're not seeing distributions. So private equity is sitting on a lot of capital. Fundraising is going very slowly. And everything's still somewhat priced to perfection. So they're not rushing out there because they see this looming recession as well. Private credit, on the other hand, that's the other side of the balance sheet, and that is looking attractive. After 2008, the banks really stepped away from the private markets and loaning corporations money, and so asset-backed loans are very attractive. Any kind of loan, but again, a private loan, you've got to do your due diligence and understand your credit. But there are lots of opportunities. Now, there's a lot of money in that marketplace, but and it's fairly fragmented with lots of different players. But corporations are borrowing even at these rates, and that's attractive.
Chris, 30 seconds before we let you go. You said multiple times, this is not the time to trade bonds. Would you ever trade bonds? What is the environment to trade bonds?
Katie, we're a buy and hold kind of investor. Because I have a 30-year investment horizon. If I have to, I can hold till maturity. We're always adjusting duration. But so to your audience, that's really what I mean, is that somebody is either trading a bond in and out or trying to mess with duration or credit exposure to try and take advantage of it. Look at the Bloomberg Ag has been very low returns. 2 years ago, negative. Last year, slightly negative. It's a really tough market to make a lot of money in fixed income.
Yep.
As rates rise, buy and hold, you can make a decent high single-digit return, which is what should satisfy people given the risk.
These minutes may raise more questions about where the Fed was 3 weeks ago than they answer. While the decision to leave rates unchanged was unanimous, during the discussion, the committee was divided. Quote, some participants indicated that they favored raising the target range for the federal funds rate 25 basis points at this meeting, the minutes say, or that they could have supported such a proposal. Instead, there was a compromise. The minutes say almost all participants judged it appropriate or acceptable to maintain the target rate unchanged at that meeting. The idea, give them more time to assess where the economy was. Most of the participants agreed that while the labor market remained very tight, there were signs it was coming into better balance. And while inflation remained too high, the economy was slowing. Many felt that the economy still had yet to feel the impact of the cumulative tightening over the past year, and the impact of March's bank problems on credit availability was yet to be determined. At least at this meeting, quote, almost all participants noted that in their economic projections that they judged that additional increases in the federal funds rate during 2023 would be appropriate. Although their dot plot submission suggested 2 more moves, how much would depend on incoming data, a point the committee stressed. One other note, Fed staff continued to anticipate the economy would go into a mild recession later this year, followed by a moderate recovery. And also, members of the committee did discuss, although they reached no conclusions on the impact Treasury bill selling after the deficit deal was reached would have an impact on interest rates on the short end.
And Mike, at the same time, looking through some of the details here, we see on our top live blog that Fed staff economists continue to forecast a quote mild recession starting later this year. That's at odds with what Jerome Powell himself has said.
And that's what we have seen from the Fed staff for the past 3 or 4 meetings. Their models suggest that the economy should contract by the end of the year, but none of the members of the Open Market Committee seem to believe that, and certainly Jay Powell has argued against it, at least saying that he doesn't think it's likely.